Good morning and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite, we have Chris Dearborn. He is the Managing Director on Nasdaq's Markets Intelligence Desk. Thank you so much for joining us today. Happy Thanksgiving. It's been a while since we've been together.
Happy Thanksgiving. Happy Black Friday.
All right, happy Black Friday. I know, but you know what? Before we get into what's going on in the markets, retail expectations look pretty strong for today and for holiday 2018.
They're looking for $1 billion in spend this year, which is up significantly from last year. Again,
A trillion.
A trillion. Did I say billion?
Yes.
I'm showing my age.
Thanksgiving hangover.
Definitely a little bit too much turkey. But absolutely, $1 trillion in spend. What you're looking at there is e-commerce taking a little bit more of that spend coming to them, so people are staying at home a little bit more. And again, Black Friday is not just what it used to be, which is get up early, go shopping, hit the deals, go to Macy's, go to Toys R Us, go to Ross stores, wherever it is that you need to go to get your stuff. And now it's really turned to a 4-day extravaganza of shopping, you know, capped off with Cyber Monday and everything else. So the spend's kind of been dragged out a little bit longer, but with that, what you're looking at is the same thing. People are buying items, they're looking for discounts, whether they're browsing online, whether they're looking online and going to the stores, or they're actually going to the stores and shopping there. Yep. The omni-channel is where it is right now, and that spend is going to be there, and that could be the boost that we're looking for to carry this markets a little bit higher as retailers, the winners, and the haves and have-nots kind of show forth who's spending in what stores and who's not.
All right, speaking of the have and the have-nots, tech, industrials, energy, weighing on the market this week. We haven't seen a sell-off like this in quite some time.
You know, energy has been really the crust of what's going on. It's down 25% from the peak back, of the year back a few months ago, and what you're looking at is $52, $53 barrel oil, and that's really weighing heavily on the large cap names that, and their stocks are really moving with it. Exxon, Chevron, the rest of them are all kind of getting beat up a little bit with that. And those guys led us higher over the summer. Now, tech did lead us higher, and it always has. And what happens when you have high-weighted names in indexes, and those companies have outperformed the market substantially, when they underperform the market, they're going to take us down just as much, and that's what you're seeing here. Whatever the fundamentals are behind each one of them, and some of them there is no fundamental change. It's just, you know, sell one, sell all, throw it out with the baby in the bathwater type of mentality. What you're looking at is the index go up with the FANG names, and the indexes come down with the FANG names.
Right. You know, it's interesting with fourth quarter volatility, particularly this week, and this is a conversation that I had with a number of the TD Ameritrade traders earlier in the week, is the VIX at 22, 23 doesn't feel like, you know, we had a 1,000-point sell-off in the Dow. You would expect it to be a little bit more elevated, and I think this is where traders are getting trapped, where they're not quite sure what to do, because the buy the dip mentality, you see that spike in vol, and we're not getting that now. And I think they need that signal before you can see some buying come back in.
It's negative sentiment. It's just sell, sell, sell. Even when you have a rally like we did Wednesday, volume was much lighter, as you expect going into a long day weekend, right? And we had a nice rally, but then we ended up selling off slowly over the course of the day. So it's not that the news has really changed anything. It's not that the economic data is bad. As a matter of fact, it's very contrarian to that. The economic data is pretty good still, even though it's not as good or as robust as it was a few months ago. It's still very good. And what you're looking at here is traders, whether they're buying the dip or selling every uptick, there's no conviction in the market right now, and that's the fear mentality. And the VIX should be higher, but it's not. That's telling you that you're not getting the participation levels that you should get when you have this type of vol. The volumes are there in the equity markets, right? We're trading over 8.3, close to 8.4 billion shares a day for the last 6 weeks. You didn't have an 8 billion share day for the entire third quarter and the consolidated tape. So what you're looking at is people who are trading, but what are they really trading? They're trading tight spreads, not really investing.
Right. So let's talk about the trading week ahead, because there's a lot, outside of earnings, there is a lot of headlines that are going to be coming out. But first, let's talk about U.S. and China trade talks. That's certainly going to be the focus.
You know, it's been an interesting problem to see. You've seen China kind of withdrawing a little bit from the markets, right? And a lot of the import costs that you see, Apple's import costs, a lot of the retailers are all coming from here, and there's uncertainty in what that's going to happen going forward. So if there's uncertainty, and you see it in the guidance from a lot of companies over the last couple of weeks with earnings, you know, they're ratcheting down their guidance numbers, and I think that's what's spooking investors. So until there's certainty, and we finally have the G20 talks coming up, people have had that circled on their calendar for a long time. Will that give reprieve to this uncertainty between the trade barrier that's being put up between the U.S. and China, and what that means for companies here in the U.S. on the investment level? If there is certainty to that, then what you'll have is certainly back into the investment space, and people who invest like certainty. They do not like uncertainty, and that's what we have here with these trade talks.
All right. In addition to that, you have a number of housing data coming out next week, and that has not been one of the more positive signs of the economy right now. I think just about every Fed speaker is on the circuit next week, and of course you have the GDP number. There's a lot going on macro-wise next week.
GDP is going to be a very interesting piece. Look to see what we have there, but more importantly, going back to the mortgage part of it and the Fed speak, interest rates are rising. There's nothing, no two ways about it, and there's nothing wrong with that. We're going from an area of quantitative easing to quantitative tightening. But the Fed speak over the last couple of days, and what we'll see what we get next week is maybe they will pull back a little bit. Yes, the last interest rate hike in December is about 70% baked in. That could change. And then the question is 3-4 times next year. What if that changed a little bit? That could be a boost to the markets as well. If the Fed dials it back a little bit and becomes a little bit more dovish, then we could see a significant change here. And I think you're seeing a lot of the Fed speak really kind of aim towards that right now. Whether it's reactionary or not to what's coming out of the White House, it is reactionary to the markets, unfortunately.
Well, it'll be interesting to see where we are next Friday.
Yes.
When we hook back up again. Thank you so much.
Thanks, Jill.
Enjoy the holiday weekend. Thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.